Hi guys, welcome to my YouTube channel. In this video, today we will talk about risk management in trading. No one enters the trading world expecting to lose money, but unfortunately, it's a reality for many traders. To minimize your losses and protect your profits, it's important to have a risk management strategy in place. Without one, it's easy to make costly mistakes that can impact your bottom line. A sound risk management strategy is essential and involves setting stop losses and choosing the right position size for each trade. In this post, we'll discuss the importance of risk management and outline some tips for developing a strategy that works for you. What are common risk management strategies for traders? Traders face the risk of losing money on every single trade, and even the most successful ones are almost constantly putting on losing trades. Being a winning trader over the long haul is a function of your winning percentage and how big your wins and losses are. Regardless of how often you win, if you don't control your risk, then you could end up blowing up your account. A proper risk management strategy is necessary to protect traders from catastrophic losses. This means determining your risk appetite, knowing your risk-reward ratio on every trade, and taking steps to protect yourself from a long-tail risk or black swan event. Set rules to keep emotions out of trading decisions. The primary reason to have a trading strategy that incorporates a risk management element is to stop you, the trader, making poor decisions that are based on emotions rather than facts and proven strategy. The best plan or strategy is doomed to failure unless it is adhered to, and emotions can get in the way. Hence the reason to have a strict trading strategy that defines when, how, and where you enter, manage, and exit trades. This obedience to a plan is core to any successful trading approach to eliminate unnecessary and disruptive emotional and psychological influences, and is why a risk management strategy is so important. Use stop losses to limit losses. One of the most important rules to have in place and to adhere to is the placement of stop losses. A stop loss is an order with your broker to buy or sell a market when it reaches or exceeds a price that you set. So, for example, if you bought an asset for $200 and wanted to limit your loss on this trade to $10, you would place your stop loss at $190. If the price of the asset unfortunately fell, if the price went below $190, your trade would be automatically exited, meaning you lock in a loss of $10. Placing an exit stop loss when you enter a trade keeps you true and honest to a strategy. It is also an essential part of being able to calculate your risk-reward ratio, which we will look at below, which is an integral part of any risk management strategy. However, it is not enough to just use the stop loss as a reference point for this calculation. The stop loss must be kept to. There is no point in placing a stop loss. Then when the market moves towards this stop loss, then move it away, thereby increasing your potential overall loss. Use trailing stops to protect your profits. Alongside using stop losses to limit your losses, you can also use trailing stops to protect your profits. A trailing stop is a type of stop order that trails behind the current market price as it moves in your favor. The trailing stop automatically adjusts to the changes in market price and follows along at a set distance, or trailing amount below the current market price if you are long, or above the current market price if you are short. For example, if you buy an asset at $100 and place a trailing stop for an asset initially at $95, but set it at $5 trailing, then your stop loss order will automatically adjust up to $96 if the stock price increases by $1 to $101. If the stock price decreases, then your stop loss order will stay at $95 for a stop loss of $5. The trailing stop is a great tool to use to lock in profits as the market price moves in your favor while still protecting against downside risk. It is important to remember that the trailing stop is not a guarantee that your position will be sold at the trailing amount, but rather it is a limit order that will only execute at or better than the trailing amount. Trade the right position size to optimize risk. One of the biggest mistakes many traders make, even those with experience, is to trade too large a position size to become overexposed to the market. So, How do you decide on your position size? There are several factors that can determine this, but there are some basic calculations you can make to get a guide to how much you should be trading in any particular trading position. As a rule of thumb, it is widely accepted that a 1% rule for potential losses on any one trade should be no more than 1% of your total trading account size, the amount that you are willing to lose in total. Many traders add extra rules to this rule that maybe you do not allow yourself to lose more than 2% on any one trading day, maybe no more than 5% in a trading week. There is generally always a trade-off between the risk-reward ratio and the hit rate, with most strategies either producing a strong hit rate, that is, the number of winners compared to number of trades, and a lower risk-reward ratio, or a lower hit rate and better risk-reward ratio. We look at these various measures and, in more detail, at the relationship between the risk-reward ratio and the hit rate in our post risk-reward ratios and hit rate. Diversify risks. Another vital factor when looking at a risk management strategy is to diversify trading risk. Portfolio diversification is an important strategy for reducing risk without sacrificing expected returns. This concept of modern portfolio theory was first formulated by American economist Harry Markowitz in his paper, Portfolio Selection, and has been widely used since its publication in 1952. Portfolio diversification is a strategy that aims to minimize the risk of investing or trading by spreading your capital across a range of different asset classes. The logic behind diversification is that by investing or trading in a variety of assets, you can reduce the impact that any single investment or trade has on your overall portfolio. Portfolio diversification is not a guaranteed way to make money, but it can help to reduce the overall risk of your investment portfolio or your trading strategy. With a particular focus on trading, portfolio diversification would require not having a number of trades that are positively correlated at the same time. For example, it can be assumed that the US stock market and the UK stock market have a strong positive correlation. They tend to go up and down with each other. So, if you were long both the S&P 500 index, US, and the FTSE 100 index, UK, you would, in fact, have greater exposure to the overall market than just two separate, uncorrelated trades. If following our 1% rule as above, you had a 1% long exposure in the S&P 500 and a 1% long exposure in the FTSE 100, you would, in reality, have a 2% exposure. And this is not just the case for two equity indices as in this example. Different asset classes can be positively correlated, for example, the USD-JPY currency pair and the NASDAQ 100. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.